Welcome to Trends with Benefits, an award-winning podcast by VanEck with a forward-looking perspective. We explore new ways of thinking about the markets, work, and life. Here's your host, Ed Lopez.
Welcome to another episode of Trends with Benefits. Today is a special episode as I'm joined by a very special guest host, Mr. Forward-Looking, Mr. All About That Crypto, Mr. Jan van Eck himself. Jan, it's an honor to host the show with you. I guess just by default, since you fund this whole operation, that makes you host with a capital H and me just that other guy.
I'm a producer as well as a co-host, yes.
There we go. And, among other things, we're going to be talking about one of your favorite topics, crypto. And for that, making this an extra special show is our special guest today, Ric Edelman. You may know him as the famed and acclaimed financial advisor and best-selling author of personal financial books, and most recently, the founder of the Digital Assets Council of Financial Professionals. Howdy, Ric.
Great to be with you, Ed. Thanks so much. Good to see you, Jan.
Good to see you.
So maybe just a quick definition to kind of get started or get your opinion on a definition. Is it cryptocurrencies or digital assets?
It's digital assets. Actually, that's half of the conversation. Cryptocurrency, which is the original phrase that Satoshi Nakamoto created 12 years ago, is inaccurate today. First of all, crypto is a scary word. Things of crypts and death and cyber scary stuff. Throw out the word crypto, it's scary. Digital. We all live digital lives. We know that. We're familiar with our digital lives. No big deal. But currency is only half the story. There are digital currencies. There are also digital assets. They are very different. A digital asset is an asset just like any other asset that has value and has a fluctuation in its price. Stocks, bonds, real estate, these all fluctuate in value. They're all assets. Same thing with baseball cards and comic books and rare stamps. But digital currencies are designed to reflect the value of the underlying. You want to go with the dog barking, or you want me to?
I'd say keep going, Ric. As a co-host, that's my 2 cents.
Digital currency, on the other hand, is meant to replicate real currency. So a digital currency is stable in value if it's pegged to the US dollar or the euro or the yen. So there are two different kinds of digital out there, digital assets and digital currencies.
So you've been a big proponent of digital assets, obviously, kind of given the organization that you founded. One of the things I wanted to do in today's episode was revisit the investment case for digital assets, in particular, kind of given the backdrop of the volatility that we've had to start 2022. Kind of curious, from your perspective, if anything has changed in your mind for that ecosystem.
No, not at all. What's been happening in the last several months is confirming the legitimacy of the technology and the investment thesis. Both the war going on in Russia and Ukraine right now, as well as the market volatility and the pricing changes of Bitcoin and other digital assets. All of this is reaffirming. This is... if there's a silver lining anywhere in what's happening in the world with the rising inflation globally and the fears that Putin is a madman and doing incredibly bad things and committing these atrocious crimes against humanity, if there's a silver lining anywhere, is that this has further demonstrated the legitimacy, justification, and permanence of digital assets.
How so?
Oh, a lot of ways. For example, if we look at the price, Bitcoin is now operating again as a asset class that is unrelated, non-correlated to other asset classes. The stock market, the bond market, the real estate market, all been falling. Bitcoin price has been rising. And this is in sync with its price performance since its inception, except for maybe the latter half of 2021. So that is good to see. Second, we're seeing the mainstreaming. We're seeing major corporations, not just the crypto companies, but major huge companies on Wall Street, such as MetLife, with a $100 million investment last year. Its CEO joining the board of NYDIG, a major crypto company. We're looking at a lot of Wall Street professionals leaving Wall Street and going into the crypto community. A lot of former regulators are leaving Washington and joining the ranks of crypto companies. We're seeing, you saw what happened on the Super Bowl. The biggest advertisers were crypto companies. They're slapping their names on stadiums and arenas around the world. So all of this demonstrates the mainstreaming. As far as the war, the most surprising legitimacy efforts come in two ways. First, there was a very big fear that Putin would get around the sanctions by converting their economy to crypto. By buying and trading Bitcoin, they would get around the sanctions, which has kicked them out of the SWIFT system and off of the global financial network. That's proving not to be the case. In fact, law enforcement loves crypto. They love the fact that Putin is trying to use crypto for one simple reason. Digital money leaves a digital footprint. So it's easy for the regulators and the legislators and law enforcement to track the movements of the Russian oligarch money when they try to do it on the blockchain. That's a lot easier for them to trace than if Putin was using cash or diamonds. So this is another illustration that crypto helps law enforcement and helps bad people from doing bad things. Simultaneously, Ukraine issued a call for help to the global community and already has received more than $100 million of donations from people all around the world in Bitcoin, as well as Ethereum and Polkadot and other digital assets. 100,000 people worldwide have come to the call. In fact, they have donated so much money to Ukraine in crypto, it's more than was donated by the European Union. This has been called by Ukraine itself an economic breakthrough. We have to remember that Ukraine, on a per capita basis, has a higher crypto engagement than any other country in the world. They were ready, and this has proven to be a lifeline to them during the horrific experience that they're all suffering right now. So this is proving, this whole conversation, the legitimacy, the permanence, the stability of this entire technology. And it's ratcheting up very, very fast and gaining attention and interest and consumer awareness. It's all good.
I get the utility for scenarios and events like what's happening in Ukraine and some other emerging market countries who perhaps adopt it as legal tender. But for investors in the U.S. thinking about simply investing in it, I mean, how do you look at it? How do you look at Bitcoin in a portfolio, for instance? Is it a store of value? Is it an inflation hedge? Or do you consider it and other cryptocurrencies or digital assets like a tech stock?
All the above. So I'm the guy who created back in 2015 what is now referred to as Ric Edelman's 1% allocation strategy. My attitude is twofold. Number one, this is the most compelling technological innovation since the invention of the internet itself. We all missed out on that invention. We didn't invest in Google and Amazon and Microsoft and the way that we should have, the way that we wish we did. This is yet the next opportunity, the first one in 30 years, with this revolutionary technological innovation. But we also know, because of the incredible volatility of the price and the incredible growth in value and in the price of Bitcoin and other key digital assets, you don't need to have an outsized allocation. You don't need to put 30, 40, 50% of your money into this. The way that an advisor would routinely say to a client, put 40, 50, 60% of your money in stocks. We don't have to do that with crypto. 1% is plenty. The history tells us that a mere 1% allocation can have a material impact on the overall performance of your portfolio. But if this thing does blow up, if it does go south, it's only 1%. It's not going to damage you financially. It's not going to interfere with your ability to achieve financial security. In other words, the water's fine and it's okay to put a toe in the water. I'm not asking you to dive in head first into a dark pool that you don't know anything about. A little bit of crypto goes a really long way. And I'm not the only one saying this. In 2018, Yale came out with a study saying essentially the same thing. Yale said if you believe that crypto will outperform by 200% over other asset classes, you should have 3% of your money in crypto. That's it.
Rick, how do you get people to take the first step? Because it seems like we're in two states of nature. 2017, when prices are rallying like crazy, hitting all-time highs, making investors uncomfortable that they're chasing a fad. And then I'll call it 2019, where you're in the middle of a crypto winter, people are second guessing the whole phenomenon. And I preach dollar cost averaging, and I said, and the volatility, you put your finger on it. That is the most difficult thing about the asset class. How do you get them to get over this? I've missed it. It's too late, or it's cheap and it's getting cheaper and it's probably a whole scam anyway.
Yeah, it's difficult, Jan, because of all the biases that people bring, their prior experiences, having gone through the 2001 tech bubble, 2008, and the credit crisis. Some of us are old enough to remember the crash of '87. It's hard to get past that inertia. And then people get a lot of misinformation. They hear about beanie babies and tulip bulbs and Ponzi schemes and pump and dump fraud. We've got to cut through all of that. Education's the key. That's why I created 4 years ago this organization, the Digital Assets Council of Financial Professionals. This is an educational group designed to teach advisors so they can teach their clients about this asset class, to understand that a lot of what you think you know is incorrect or outdated, flat out misleading, and that when you dive into the info on a more deep, rational basis, you discover that a lot of those fears melt away. They really aren't a concern. If you go with the attitude of three things, and you cited one of them really importantly, Jan, three things. One, maintain a diversified portfolio. Crypto should be 1 or 2 or 3% of your allocation. It shouldn't be 50, 60, 70. Second, have a long-term focus. We need to understand that this technology is just getting started. It's only 12 years old. Think back to when Amazon was 12 years old, when Apple or Facebook were 12 years old, when Google was 12 years old. In fact, go look at those stock charts of the first 12 years of those companies. You'll see the same exact volatility that you've seen in Bitcoin. It's new. It's a revolutionary new technology, and it's going to have growing pains. And that means you need to have a long-term perspective, trusting in the technological innovation that offers major benefits for global commerce. Third is what you said, dollar cost averaging. Don't invest and forget. Invest on a continual basis. If you're investing on a regular monthly basis, small amounts over long periods of time, that's how you're more likely to reduce the risks while increasing the likelihood of profitable returns. So if you just do those few things, you'll be amazed at how additive digital assets can be to your overall portfolio.
I wonder how your opinion changes, if at all, as you move away from Bitcoin to Ethereum and other alternative digital assets.
Yeah, Bitcoin is the first, and it still is the biggest. About half of the entire crypto market is Bitcoin. So I'm a big fan of Bitcoin. How can you not be? It has such a huge head start, such a huge lead. But Ethereum was invented in 2015, and I'm frankly even more excited about Ethereum than I am about Bitcoin. I own more Ethereum than I own Bitcoin. Why? Because Bitcoin, for all of the benefits that it offers, at the end of the day, Bitcoin is dumb money. Bitcoin is like the dollar in your pocket. It's just there. If I send you Bitcoin, you receive it. End of story. Well, I might not want you to receive it, at least not right now. I might want you to receive my Bitcoin only if you do something for me, such as deliver the deed on a house or concert tickets. I might want an if-then condition. In other words, a contract. And of course, contracts are a fundamental attribution of business around the world. Ethereum allows you to create those if-then contracts. In other words, instead of being dumb money, Ethereum is smart money. So I'm a big fan of the utility of Ethereum to help business execute its operations. So that's why Ethereum today is probably about 30 to 40% of the entire marketplace. So between Bitcoin and Ethereum, you have 80 to 90% of the entire crypto community. In other words, if all you do is buy those two coins, Bitcoin and Ethereum, you'll be fine. It's kind of like Coke and Pepsi. I mean, there's a whole bunch of other soft drinks out there. If you just stick to Coke and Pepsi, you'll be fine. And that's true in just about every industry. There are always 3 or 4 major market leaders in any business or industry. You buy the major leaders, you'll do fine. Does that mean you'll make the most money? I don't know. Probably not. There are other coins that are likely to rise faster, but are they going to stick around? Are they going to be here in 10 years? Not as likely. So Bitcoin and Ethereum, the other 13,000 coins, go ahead and knock yourself out if you want to. That's a personal choice.
Do you think investors should be lending into the crypto ecosystem to earn yield?
You know, one of the downsides of crypto is the same as that of most tech stocks. They don't pay dividends. If you go back to 1926 and you look at the performance of the S&P 500, the Dow Jones Industrial Average, the stock market overall, many people are surprised to learn that half of the total profit did not come from increases in share price, did not come from growth. Jan knows this in his sleep. The profits came from the dividends that those companies paid. The dividends from IBM and AT&T and General Electric and on and on and on. If half the profits are coming from dividends, then that makes sense. You want to invest in something that does, in fact, pay dividends. This is why people love to invest in real estate. Real estate prices can rise, and I'm also earning rental income. This is why people generally don't like bonds. Bonds don't rise in value. You lend someone 10 grand, they give you back 10 grand. You're only earning income. You're not getting growth. So this is why dividend-paying stocks are so popular. It's why real estate is so popular. But crypto, Bitcoin, Ethereum, and all the others, they don't pay income. You're betting that they're going to rise in price. That's the only bet that you have the potential to make money on. Wouldn't it be cool if you could earn income? Well, now you can. Two ways. You can engage in lending, which means you lend your digital assets to somebody else. They'll pay you interest anywhere from 4 to 20%. Or you can engage in staking, which is where you put your coins onto the blockchain to help validate the transactions that are occurring. And again, you can earn 4 to 15% in income. So investors should really take a serious look at the income producing potential of crypto because it can dramatically increase your overall returns. There are risks, as is always the case with every investment, and you've got to evaluate if earning that 5 or 6% is worth the risk that you're taking to your underlying investment. So you've got to decide what makes sense for you. But yeah, it's certainly something worthy of consideration.
I guess my question, Rick, is how far along are we, I guess, along two dimensions? One is your educational mission with financial advisors, but then also the infrastructure. You can't do what you just said about staking and lending at Merrill Lynch or Fidelity these days. And even the cryptocurrency exchanges like Gemini and Coinbase are being constricted by the SEC in doing those types of activities. So where do you think we're at with that stuff?
It's very early on. It's very early, and that means it's not for the faint of heart. There's still not a lot of regulation, which is why major Wall Street firms are not yet engaging. As you know all too well, we don't even have a Bitcoin ETF, the most basic of investment opportunities. It's unconscionable that the SEC hasn't said yes yet. I find it ironic. They've said okay to a 3x inverse fund, but they won't say okay to a Bitcoin ETF. I don't get it. Doesn't make any sense to me. But that's where we are. So as a result, dealing with a lot of sectors within the crypto community remain cumbersome. There's no FDIC or SIPC to protect you. A lot of these companies are new, and you're not sure how well financed or funded they are. In many cases, you don't even know where they're located or who the people are behind the curtain operating the businesses. So, we do have those issues, which is why my attitude is if you just stick to the basics, Bitcoin, Ethereum, that is offered or made available to you through very established companies, and there are a number of them out there available now, that's a reasonably effective way to play it without getting totally silly about it. Therefore, to answer your question, we are in the very early stages. This is the first or second inning. We only have about 300 million people on the planet who own Bitcoin. There are 7 billion of us. Now, just to give that in context for you, think back to when Facebook had 300 million users. Think about what the price of Facebook was at that time. Today, Facebook has 3 billion. Almost half the planet has a Facebook account. pretty much everybody who has an internet connection is on Facebook. They've gone from 300 million to 3 billion, a 10x increase. The stock price didn't go up 10x. The stock price went up about 1,000x. In other words, the growth of the price of Facebook grew much faster, much bigger than the growth of the number of users. This is called Metcalfe's law, that the size of the network grows exponentially relative to the number of users on the network. The value of the network grows much faster. And that's why if we're looking at the fact that only 300 million own Bitcoin, what happens when we double that number? Which, by the way, I'm expecting by the end of 2022, there will be 500 million on the planet who own crypto. What happens when we hit 1 billion people? What happens when we hit 2 billion people? The rate of growth of these exponential technologies suggests it's not going to take decades. It's going to happen within just a few years. And as that occurs, because there's a limited supply of Bitcoin, when you have a massive new demand and a limited supply, that suggests that the price is going to grow dramatically. So for that reason, I personally consider Bitcoin's current price to be very low in comparison to where it is likely to be in just a few short years.
That's interesting. I mean, I do too. What I also wonder about is, will the volatility of the price go down, specifically the drawdown? You know, it just seems to me that as usage expands, like you're talking about, there's more buyers on dips. Right now, I'm not saying there aren't 50% corrections in the price, but I don't know, fingers crossed, we don't see a 90% correction from the 2021 all-time highs. Do you see it the same way?
Yes and no. I mean, I agree with you. I think the days of a 90% decline like we saw in 2018, I think those days are gone for the simple reason that there's too much institutional involvement now. These hedge funds and venture capitalists, private equity funds, and endowment funds, these billionaires, all of whom are engaging. Let's keep in mind that last year, institutional trading was 3 times more than retail trading in crypto. So the institutions are already taking over the space. And these are smart people. And when they see a massive decline in price, they consider it a buying opportunity. They're not going to wait for crypto to fall 90% before they jump back in. They have so much money at their disposal that it's just, to me, inconceivable that Bitcoin could collapse to that degree. Could it fall 50? Yeah, it could. But you get to support levels the same way you do in the stock market. You get to a point, like we saw in the pandemic, where the prices fall so much so fast, the institutions finally say, hang on a minute, that's insane. These companies are worth the prices they're now trading at. And that's why I'm a little uncertain about the level of volatility going forward. In other words, there's a side effect of having the institutions engaged in crypto. The side effect is that they're beginning to treat crypto the way they're treating stocks. We saw this in 2021. When they sold out of the stock market, they also sold out of the crypto market, even though one has nothing to do with the other. So I think that we're going to see a little more correlation in the future between crypto and the stock market than we have seen over the last decade, because institutions simply regard this as yet another asset class, like emerging markets, as opposed to something totally new and different. So the good news is we'll see price stabilization. The bad news is, well, the volatility will probably persist until the institutions collectively agree that this is a mature asset class, and that's going to be a while before that happens.
That's interesting, because you see that with gold as well, that in these risk-off periods, they dump their gold or they need liquidity, right? So they sell their gold holdings over the short term. And a lot of times investors disappointed on a particular day or a particular week. You know, gold's supposed to be doing well. And it's like, well, you know what? We need to raise cash, folks. And that's an interesting perspective.
You asked one other thing that is worth addressing, and that's the growth at DAC-FP and the advisors in the community. There are 300,000 financial advisors in the United States. We control collectively about 2/3 of all the investor money that is out there. Independent advisors alone represent $8 trillion of investor money. Today, according to the most recent surveys, only about 16% of financial advisors are recommending crypto to their clients. So we've got 84% of advisors, 8 out of 10, not engaged. What happens when those advisors do engage? And if they all recommend a 1% allocation, we're going to see an explosion of new money, new wallets, new accounts in this space with, I think, has to be an attendant increase in price.
What's been the biggest roadblock for financial advisors to date?
There are two, Ed. Number one is the absence of a Bitcoin ETF. I think Jan is doing the exact right thing of trying to get an ETF through the SEC's approval process because ETFs are the most popular investment in America. We know their advantages. They're cheap, they're liquid, they have full transparency, they are convenient and easy to own, very tax efficient. It's very easy to build a diversified portfolio. I mean, what's not to love? I've been a huge fan of ETFs for 20 years. So we know that this is the way people like to invest. It's also the way advisors like to invest. It's easy for them to manage their practice using ETFs. So the absence of an ETF is keeping investors and their advisors out of the marketplace. When the ETF becomes available, we're going to see an immediate explosion of engagement because it's a familiar vehicle that advisors can easily include in their existing diversified portfolios. So that's the first reason. But there's another reason. This one is a more, I think, significant. It's a deeper reason and a more troubling reason. You know, I've been a financial advisor for nearly 40 years now, and I have a lot in common with a lot of advisors, meaning I'm over 60, and that is the average age of advisors in this country. I built a very successful financial planning practice, and that's true of most advisors in this country. They're very successful. Most have been doing this a very long time. I've been doing it almost 40 years, and that's true for most advisors. They've been doing this for 20 or 30 or 40 years. Most advisors have a large pool of clients that they serve. Most are managing a lot of money, hundreds of millions, often billions of dollars, and their clients are happy because look at the returns over the last decade, right? The stock market, the bond market, the real estate market, everything's done well. It doesn't matter what you owned, it did well. Your only choice over the last decade was investments that were going to do well or really well. So everybody's happy. Advisors are happy, clients are happy, and advisors in their 60s, been doing it for 20 or 30 years, a stable pool of happy clients. The advisors are making a lot of money, $500,000 or more very often, and they're playing golf 1 or 2 days a week. Along comes crypto, something totally new and different that makes no sense, that has nothing in common with any other asset advisors have ever experienced. Nothing in common with stocks or bonds or real estate or gold or oil or commodities. And we've seen incredible price volatility. We have seen governments initially say, we don't know if we like this. We saw Mt. Gox and Silk Road way back in 2012, causing advisors to say, I don't want to upset my business. I don't want to upset my clients. I don't want the risk of hurting my reputation. I don't want to hurt my regulatory status with the SEC, and I don't want to hurt my revenues. So I'm just going to tell my client to ignore this. I'm going to wave it off with a dismissive hand, telling them it's a tulip bulb or a beanie baby, stay away, it's a fad or a fraud, and I'm going to keep doing what I'm doing because I'm fat and happy. My clients are fat and happy. When I say fat, I'm talking about our wallets. We're making a lot of money. We got a lot of money. Why mess that up by doing something new and different? And I think inertia has prevented a lot of advisors from intellectually expressing curiosity about this. And they simply haven't bothered to engage. And that, I think, is a huge disservice to their clients and, frankly, to their own practices. In fact, I take it a step further and wonder, are they truly fulfilling their fiduciary obligation to serve their clients' best interests if they are not considering the merits, the potential benefits of this asset class for inclusion in client portfolios? I wonder if they're fulfilling their fiduciary obligation, and I wonder if over time, SEC examiners are going to raise those very same questions. The conversation is shifting. It used to be, why are you buying crypto? Now the conversation is becoming, why aren't you buying crypto?
So just to kind of tie the bow on the DAC FP, what can advisors expect by interacting with your organization now?
Well, I formed DAC-FP 4 years ago because having realized that crypto is an incredibly important technological revolution that is transforming global commerce, bringing with it incredible investment opportunities like we've never seen. At the same time, the crypto community is making some really cool products and services that are of value to advisors and their clients. The two are not talking to each other. So I created DAC-FP to serve as the bridge, to connect the two together, to let the crypto community understand the needs of advisors and how they like to serve clients, and helping advisors understand the opportunities that are available that can help them build their practice and better serve their clients. And so we create a lot of educational content. I am a financial planner by heart, and so DAC-FP is strictly educational for advisors. We don't have products. I'm not selling any investments or recommending anything in particular. Our goal is simply to educate, help you understand this asset class and how you might be able to incorporate it in your practice, whatever your point of view happens to be. I can even teach you how to make money with Bitcoin by hating Bitcoin. So it's not a question of loving this. It's simply a question of understanding this. The way you understand annuities. Every advisor has an opinion about annuities. Some of us hate annuities, but we're expert on them. We can talk in great detail about why we hate annuities or why we love annuities. That's what I want you to be about Bitcoin. I want you to be able to articulate to your client why you love it or why you hate it, why you're recommending it or why you're not. We have a lot of other benefits for those who go through the enrollment. We have an advisor directory to connect you with consumers looking for someone who can help them. We have the Yellow Pages, which gives you access to every product and service in the crypto space. So it saves you time in looking for the vendors who can help you. And a lot of other content and information and ways that we link you to boost your knowledge so you can better do your job. So we're really excited about it. We launched this less than a year ago, and we already have over 2,000 advisors who have enrolled. Half of them have finished the course from 8 countries. So it's going really, really well. People love the program. Everybody raves about it. And we're really excited to be able to deliver this content. We are partnering with the CFP board, with the Financial Planning Association, the Investment Advisors Association, the Money Management Institute, XY Planning Network, NAPFA, and other organizations, because there's really no other outlet that people have to get the knowledge they need about blockchain and digital assets. So we're excited about being able to do this for everybody.
First of all, I do want to say that your book is really awesome. I think a lot of books on crypto are too technical, or they talk too much about monetary theory, or they talk too much about the regulatory angle. And I really thought your book was a great intro. One of the problems I have with the digital assets world is that so much is changing all the time. And I guess you're probably going to tell me that's why you're starting a newsletter. But how do you keep up with all of the things that are going on? I mean, NFTs really weren't even a thing a year ago. And now there's communities, there's all these different kinds of things. It's popular culture, to your point. How do you keep up? What do you recommend to normal humans?
It's one of the big challenges, Jan, and thank you so much. I'm so glad that you enjoyed the book, and thank you for your testimonial. The book, The Truth About Crypto, comes out May 10th. And you can order it right now on Amazon or your favorite bookseller. We're very excited about its launch. You're right. This tech is growing exponentially, and it's really, really fast. For example, a year ago, as you said, none of us had ever heard of an NFT. It wasn't until Beeple sold his artwork online for $69 million. That was when we first heard about it. 9 months ago, you never heard of DeFi. 6 months ago, you never heard of DAOs, decentralized autonomous organizations. And 3 months ago, you never heard of the metaverse. So all of this is changing very rapidly. So we are doing all the heavy lifting. I spent 12 years in this space, almost. I started in 2012 in the crypto space. And my book is the sum knowledge I've learned over this period of time. The certificate program we created is all designed to give you a speed course, so you don't have to take a decade to learn what I've learned. But as you noted, Jan, the course is already getting out of date. So what are we doing? This year, we're launching 8 additional modules. on the metaverse, on NFTs, on taxation. The taxation module is coming out in like a week, and we have other modules that will be launching monthly for the rest of this year. All of those courses are available for free to those who enroll in the certificate program. And we're constantly, because I'm now spending pretty much full time of my effort doing this, along with our team. We now have 21 employees. We are spending our full time on this subject, distilling it all, bringing it to you through our webinars, our blog, the content online at DACFP, my new book, The Truth About Crypto, and so on, to help it make it easier for you to stay current, because it is, as you noted, changing so rapidly. And you've got a day job. You know, you're busy working with your clients all day long. You need the headlines, you need the quick hits, the short info that you can digest rapidly and quickly. And that's our job of getting that content to you. In an advisor perspective, that's the difference. There's a lot of content, a lot of websites out there, a lot of daily news, but it tends to be generic. It tends to be written for the tech world. It's not really advisor-centric, investor-centric, and that's really our focus. And we're pretty unique in the delivery of that.
What I want to do is move beyond financial planner part of the ecosystem and just ask you a little bit about the two other bookends. One is individual investors, and the other is institutional investors. A lot of institutions, endowments, and foundations have participated in crypto really through venture capital funds, where they were lucky enough to get involved very early in some of these tokens or startup companies like Coinbase. And they've made a lot of money, but they seem very reluctant to invest in the tokens directly. Is that your experience, and do you see that changing?
I agree with your observation. I am not sure that's going to change anytime soon. Investing in tokens directly is different from investing in the company that makes tokens available. Not all chefs have to be overweight. Just because you make a lot of chocolate doesn't mean you need to be eating a lot of chocolate. So I know a number of the members of the Mars family. None of them are obese, but they sell more candy bars than anybody in the world. So where the smart VC and PE money is going is in the picks and shovels route. They're investing in companies that are building the infrastructure that makes it opportune for investors to buy NFTs and tokens and other digital assets. They're not necessarily buying them themselves. In other words, they're following the pattern of Levi Strauss. He made more money in the California gold rush than any gold miner, but he never mined for gold. He simply sold blue jeans to the gold miners. Sell them picks and shovels. Don't worry about mining gold. And so I think the smart VC and PE money is in the infrastructure play. I don't think they need to be necessarily raising funds to buy NFTs, because that's much dicier. You know, these folks aren't raising funds to buy artwork either. They're not buying Picassos and Rembrandts. Instead, they're buying the buildings that are leasing to museums that are buying the artwork. And so I think that approach is what we're going to continue to see in the digital asset space. I kind of like that because it allows investors to get a different type of play. So if you want to go into the NFT route, you can. There are funds that are now allowing you to do it. But if you want to go in the infrastructure route, there are hedge funds, PE funds, and VC funds that are allowing you to do that as well.
Then let's talk about individuals. Some individuals are way smarter about digital assets than financial advisors. And I'm sure some financial advisors are scared to talk to them because the learning curve is steep and some individuals know so much. Do individual investors need financial advisors help? I mean, there's 68 million clients on Coinbase. Tell me why they need financial advisors.
Yeah, your observation is correct. Millions of investors know more about crypto than their advisors, and they're buying crypto without telling their advisors about it. It's something I tell advisors all the time. Your clients own crypto, just like your teenagers are drinking beer. They don't want to tell you, and they're either embarrassed about it or they're afraid you're going to react negatively. You're going to chastise them or ridicule them, and they don't want to hear it. Your ignorance, your lack of knowledge is giving you a bias that's harming your credibility with your client. These clients are going directly to Robinhood or Coinbase or Gemini, they're buying crypto on their own. They're going to OpenSea for NFTs. They're turning to their own teenagers for help in doing it all. Can the advisor engage? Do these folks need their advisor to engage? And the answer is absolutely yes. And I'll give you a lot of reasons. Number one, consumers we know, individual investors, are often their own worst enemy. They don't know what they don't know. They act too often emotionally. They make the wrong decision at the wrong time for the wrong reason. They need the hand-holding of an independent, disinterested professional, someone who's not emotionally engaged, because after all, it's not my money. You know, I remember going to the doctor once who had to do something to me, and I said, "Is this going to hurt?" And he said, "Not to me." And so that's kind of what we are with, I need to advise you on crypto because it's not my money. I can be objective where you cannot. You're emotionally engaged. This can help you avoid the risk of getting into a scam that you think is legit. There have been thousands of scams that the FTC, the SEC, FINRA have all identified, the FBI. We need to protect our clients from doing it wrong because they get duped or they're doing too much. They have too much of their assets in this asset class. Or even if they started with my 1% allocation, crypto has been the best performing asset class and it might represent 10%. We need to help them rebalance so that they're not taking excessive risk, so that they can reduce their allocation and capture those profits. And by the way, what happens when they do that? Taxes. We need to help our clients with their tax planning, helping them with tax loss harvesting, tax management, helping them reduce their tax liability. And oh, by the way, one final subject. If they've got an account at Coinbase, that account is in their name only. It's not joint with a spouse. It's not a trust account because Coinbase won't let you open those, which means you haven't dealt with your estate planning. What happens if you die? Does your spouse have the password? What happens if you die? Is it incorporated into your estate plan? Who is going to be the heir of that asset? Often it's a huge asset because the growth of this asset has grown so dramatically. If you're looking to make annual donations, have you considered donating your appreciated crypto? Fidelity, Schwab, both have some of the biggest donor-advised funds. Fidelity accepts crypto, and they're now the largest donor-advised fund in the country, the largest charity in the nation, because people who own crypto are donating it. We saw what happened in the Ukraine. We talked about that earlier. You need professional financial advice to guide you through portfolio management, asset allocation, tax management, estate planning. This has nothing to do with, do I know what Bitcoin is? Any more than an advisor saying to a client, do you own real estate? If you have a whole bunch of rental real estate, you need my help in managing it. Do you own a wine collection? A rare coin collection? Do you have an exotic car collection? You need my help to manage the asset for you. That doesn't mean I'm an auto mechanic. It just means it's an asset class and you need my help with it. And advisors need to realize they need to help their clients, and investors need to realize that their advisors can, in fact, give them help in areas they know nothing about.
As we close up, we've talked about your forthcoming book. You also have a podcast, The Truth About Your Future, where you cover not only wealth aspects, but health and lifestyle. Kind of love to know the inspiration around that podcast, but also give you an opportunity to expand upon the topics that we've been talking about. What's one long-term trend you see playing out over the next year or several years?
In a word, longevity. And that is the basis of my radio show, The Truth About Your Future, which airs nationally on radio stations across the country, and it's also a weekly podcast and video cast. We're at the stage now where there are really only 5 subjects that matter in the field of personal finance, and it all begins with longevity. If you're alive in 2030, you can expect to live to age 100 or beyond. Medical science, through rapid innovation, we are going to cure the leading causes of death over the next 10, 15 years. We're talking diabetes, heart disease, respiratory illness, cancer itself are going to be cured. As a result, we're living longer than ever. Already, humans are living longer than any time in history, and we're continuing to grow that. We're adding about a month a year to our lifespans, and pretty soon we're going to be adding a year to our lifespans. The longer you live, the longer you're going to live, and you're going to live likely to age 100 or beyond. So longevity is the number one dominant theme and causes implications on everything else. Number one, retirement security. If you're going to live to age 100, will your money last as long as you do? That's a huge issue because we already know most Americans are reaching retirement woefully unprepared. And this is a huge issue, not just in the United States, but globally. And this is why exponential technologies is a major theme, because these are the technologies that are going to address and solve those issues. And the most impactful exponential technology from an investment perspective is blockchain and digital assets. And then finally, the fifth subject, if we're going to live to age 100, you better take care of your brain and your body, because we only have one of each. And so we have a big focus in my show on those issues, dealing with Alzheimer's and other solutions that we are watching medical science develop that are going to help us live not just a long lifespan, but a good long health span as well, so that we are as healthy for as long as we are alive, which is not the case today. So those are the 5 subjects that my radio show and podcast are all about. And it's super exciting to be focusing on this. And you can learn about the show. You can download it, stream it at thetruthayf.com, and just Google The Truth About Your Future.
That's awesome. And also your answer kind of leads is a great segue into my trend or fad. So I'll start out. The first one, early retirement, trend or fad?
Fad. It's gone. Instead, retirement is not going to exist in the 21st century. If you're going to live to your 80s and 90s, you're going to be healthy. You're going to continue working, partly because economically you'll need to, but also you're going to want to. If you're healthy, you're going to want to continue to contribute to society, give back, mentor youth. You might not work 60 or 80 hours a week like you did, historically, but you'll work 10, 15 hours a week, 20 hours a week doing something you totally love. Retirement is a 20th century innovation, will not exist in the new century. It's a fad and it's gone.
Bored Ape Yacht Club, trend or fad?
It's a trend. It is one of the most dominant NFTs in the marketplace, so it's a trend. However, the Bored Apes themselves may prove to be fads, and if the inventors and operators of it have anywhere near as smart as I think they are, they'll pivot. They'll reinvent themselves in order to stay vital. Otherwise, they'll go the way of Beanie Babies and tulip bulbs. And so I think that the tech will prove to be a trend. Whether or not they survive or not, they may prove themselves to be a fad if they're foolish.
Okay, this is a little snarky, but the ARK Innovation ETF, trend or fad?
Trend. It's a key investor in exponential technologies, and the fact that it is as low as it is, it represents a massive buying opportunity. I'm an investor in that fund.
Remote working, trend or fad?
Trend. There is no question that the pandemic showed us. We left the workforce. We left the office kicking and screaming. Now that we're home, we're leaving the home kicking and screaming. We are enjoying the lack of the commute, the money we're saving, the ability to work wherever we want, whenever we want, maximizing productivity via online tools like the one we're using right here. So this trend is definitely going to stay, going to grow. I've been blessed by this in the sense that my 21 employees, more than half of them are all over the country. In the past, I would have been limited to hiring people in my geographic area to work in my office. Now, I don't care where they are. They could be anywhere in the world, and we work with contractors all over the world. So this trend is always going to remain. It's not going to necessarily be as extreme as current. You have some companies saying that will never bring you back to the office. I'm not so sure I believe that. But the notion of remote working is definitely a trend.
I'm happy for that. And then finally, trend following, trend or fad?
I hope it's a fad. Unfortunately, investors have historically demonstrated themselves to be pretty dumb, and they do follow trends, not understanding that the trends that they're following are actually fads. And they end up hearing about it after it rose in value, so they buy it when it's high, and after it stops being popular and the price falls, they end up selling it in disgust when the price is low. So they end up buying high and selling low, which is the exact opposite of the way you're supposed to do it. So I'm afraid it's a trend because it's a very negative one.
Well, this has been awesome, Rick. Thank you very much for your time.
It's been a lot of fun, Ed. Jan, always great to be with you as well.
And just remember, it's Ric Edelman. I had to say that.
Thank you very much, Jan.
I listened to so many hours of your radio show.
Rush Limbaugh had his ditto heads, and the Grateful Dead, have the Deadheads. And folks who have been following me know to go by Rice Delman, because nobody can spell Ric Edelman. So Rice Delman, if you want to find me.
Oh, well, this has been fun, gentlemen. Thank you very much. And thank you for tuning in to another episode of Trends with Benefits.